In lesson 2, we describe the forms of capital, and for each of these forms, I will present 2 case studies. As a reminder, here are the forms of catalytic capital and how they enable impact. Price or accept an expected rate of return that is below market relative to the expected risk. This is in relation to what commercial investors will do. Patience by accepting a longer or especially uncertain time before an exit. Position is when junior investors are not compensated for their additional risk. For instance, junior investors that receive the same or even lower interest rate than senior investors while taking a first loss position. This is done in order to unlock additional capital. Pledge by using guarantees to unlock more capital or securing somebody else's investment. Purpose when an investor accepts non-traditional terms to meet the needs of an investee, for example, unconventional or no collateral, self-liquidating structures, smaller investment sizes, higher transaction costs, and so on. These forms often occur at the same time in a deal, so they're not compartmentalized categories that exclude each other, but there are other features that you can encounter in the same transaction. So I will go on and present 2 case studies for each of these forms, starting with price, accepting an expected rate of return that is below market relatively to the expected risk. In 2020 at Tonic, we featured Work Africa, a company that works with low-income farmers in Ghana who are trapped in the small farm cycle of poverty as they farm almost entirely manually. They tend to spend most of their time doing low-value tasks such as manual land preparation, planting, harvesting, and hand weeding. Work ideated a program called Service Delivery Units. Through these units, Work could sell regenerative farming inputs as a service, enabling the farmers to access the best available machinery, agricultural practices, and technical advice, and training them to perform high-value tasks. In 2020, Work raised a $5 million bond to finance the first 2 service delivery units. It is concessionary because the bond pays 5% annually over 5 years. It differs from commercial expectations because the bond pays a lower interest rate than probably commercial investors would have expected, and they might also have demanded a collateral. It is needed because there is a lack of investments in smallholder farmers in Africa, and the impact that it catalyzes is to seed and validate a new model. So far, this model had enabled 626 low-income farmers, most of them women, to increase their earnings from $342 per year to $995 per year, almost 3 times over. This impact expectation justified the sub-commercial investment return for the investors. Now let's take a look at an investment fund case study. This is Social Alpha Investment Fund, which invests senior and subordinated debt since 2010 in leading impact ventures in Latin America and Sub-Saharan Africa. It is a capital preservation debt investment. Its stated objective includes investing in companies that identify commercial solutions to the Sustainable Development Goals to address poverty and preserve the environment. It also invests with a gender lens. At the same time, it's also the first institutional investor that supports companies as they grow and scale up in a way that other commercial lenders do not do. It is concessionary because the fund targets a net 3 to 5% IRR. It differs from commercial expectations because in our experience, the fund offers a lower interest rate and limited diversification. At Tonic, we have seen a private debt fund targeting SME lending in emerging markets, targeting about 10% IRR with a portfolio spread over a larger number of transactions. It is needed because access to capital is one of the main limiting factors to the growth of SME, small and medium enterprises in Africa. And the impact that it catalyzes is to directly address poverty reduction investments. And also the fund is the first institutional investors to provide scale and support to the SME's growth. The direct impact of Social Alpha is something that inspires many investors to deploy capital in the fund, making it one of the debt funds with the longest track record in impact investing. The next 2 case studies are about patience, accepting longer or especially uncertain time period before an exit. Med Agriculture Perennial Fund is a US fund providing organic transition operating loans to help farmers expand their acreage, and farmers through this low-cost capital can also access individualized farm plans and market of takers. As you can see from the image in the slide, one of the issues that limits a transition to organic farming in the United States is that to get an organic certification, it takes 2 years of transitional time. During these 2 years, agricultural produce cannot be labeled as organic, and as a result, during transition, the revenues are down for the farmers and it's harder for them to afford the transition. The Perennial Fund provides operating capital through revenue-based financing loans that allow the farmers to repay the loan based on a percentage of their revenues. So until when they obtain the certification, the farmers will make smaller payments. This is concessionary because the investment will be repaid only where farmers will be repaid faster, only when the farmers are able to generate greater revenues after the transition to organic farming. So there is an uncertain repayment date. It differs from commercial expectations because commercial lenders would have required higher rates likely or a collateral such as a mortgage loan with amortization. It is needed because it fills a market gap. Lack of lack of operating capital to finance a transition to organic farming is what prevents farmers to switch to regenerative practices and organic agriculture. And the impact that it catalyzes is to seed and validated a new model to enable the transition to organic farming. The next example is C-Note Wisdom Fund, which is a private debt fund created by C-Note. It's a fixed income vehicle that increases capital access and lending for women of color-owned businesses in the United States. Money is deployed by CDFIs, community development financial institution partners that lend through affordable priced loans and provide also training. It is concessionary because there is a 5 years lockup, and the fund pays 1% per annum as of September 2022. It differs from commercial expectations because another impact investment fund offered by C-Note, the flagship fund, pays 2% per annum with a 30-month term and quarterly liquidity. So the Wisdom Fund is less liquid and pays a lower interest rate. This is needed because there is a lack of investment in women of color and business training, and the Wisdom Fund fills this gap with patient capital. And the impact that it catalyzes is to reach an underserved population and to address biases in capital allocation. Now let's discuss two case studies about position, taking a subordinated position or undercompensated risk. Please note that not every subordinated position is a form of catalytic capital on its own. It requires that the junior investors take an additional level of risk without being remunerated for that, so basically being paid with lower interest rate. The Women's World Banking Capital Partners Fund 2, it's a blended finance, gender lens private equity fund with a dedicated technical assistance facility for women, financial inclusion, and empowerment. It invests in financial institutions in emerging countries that serve women and promotes inclusive corporate policies to their portfolio companies. One of the distinguishing features of their second fund is that the fund leverages a blended finance capitalization structure. What it means is that there are different priority of returns and expected risk based on the appetite of every investor. In the image on the screen, you can see their Fund 2 structure. It leverages risk mitigating development capital, Class B, to attract commercial capital, Class A, to the impact investment gender lens investing space. Class B, so the junior equity, provides a first loss position and mitigates the losses and boosts returns of Class A investors, the senior equity investors. This is concessionary because Class B investors have a junior position and the return is capped at 2.5% IRR. It differs from commercial expectations because Class B investors take an undercompensated risk since they protect the position of Class A investors without having a greater financial return upside. It is needed because it mobilizes more risk-averse investors who can invest in Class A equity, and the impact that it catalyzes is to scale up funding for underserved demographic group in developing countries. Let's take another look at another blended finance fund structure. This is the Santander Solar Energy Transition Fund, which invests in solar assets in sub-Saharan Africa, where either the electric grid is often not reliable to power companies or where opportunities exist to displace diesel and other fossil fuel generators. The purpose of the fund is to stimulate the development and investment in the so-called off-grid sector, so outside of the fixed electricity grid, for energy services in Africa. In 2020, Tonic members participated in an investment offering that had 3 layers for a total of 70 million. It is a concessionary investment, especially for junior investors, because their return ranges between 0 to 3% over a 9 years note, subordinated to the senior tranche. It differs from commercial expectations because senior investors receive 6% over 5 years. Arguably, they also senior investors play a catalytic capital role because they're investing in a difficult geography, but the junior investors are taking greater undercompensated risk for a lower interest rate. This undercompensated risk will be an unusual dynamic in mezzanine finance, but it's more typical in catalytic capital. It is needed because junior investors can mobilize capital from more risk-averse investors, and the impact that it catalyzes is to scale up funding for underserved geographies and to grow the off-grid solar sector. The next form of catalytic capital is pledge, which provides credit enhancement through a guarantee. Through a guarantee, the capital is not dispersed upfront, so somebody might not agree it's technically an investment, but rather an existing pool of capital or an investment or account. It's earmarked for guaranteeing somebody else's position and absorbing potential losses. By doing so, more capital is unlocked, and the guarantee can be considered catalytic capital investments, even as the underlying assets remain invested somewhere else, perhaps at commercial rate of returns. One of the organizations that has mostly successfully implemented this model and reached significant scale is MCE Social Capital. It provides flexible capital to enterprises committed to generating sustainable livelihoods in emerging markets with a focus on women and the environment, and to allow these enterprises to scale and better serve their customers, their employees, and their communities. MCE has a guarantor program that enables the company to raise third-party capital at lower returns. It works like this. An investor can become a guarantor by earmarking an amount of capital or an investment to MCE, and it will cover potential losses of the MCE portfolio. Through this guarantee, MCE can approach third-party lenders and raise senior capital, senior loans at very affordable rates because it's already guaranteed. At the same time, the guarantor can still keep their capital invested somewhere else. For instance, they may keep their investment in a high-yield savings account that pays more than the projected loss on the guarantee. For instance, as of December 2021, the two guarantees programs offered by MCE had historical portfolio losses of 0.5%, which is lower than the rate of return of many high-yield liquid products. This is concessionary because the guarantors will take a loss on the amount they pledge, and it differs from commercial expectations because the guarantors are not remunerated for this risk. It is needed because they enable MCE to raise loans at lower rates and mobilize more capital, and the input that it catalyzes is to give access to low-cost capital to MCE, so MCE can then have a lower interest rate applied to the end borrowers. We also have another example for pledge. This is the Collaborative for Healthy Communities, which finances community health centers, which are providers of primary and preventive care to some 25 million people in low-income communities around the United States. This collaborative was created in 2012 by two community development financial institutions, the Low Income Investment Fund, also called LEAF, and their investment fund, the TRF, that wanted to finance federally qualified health centers to serve low-income consumers. However, they were less familiar with underlying considerations, and because of that, they leveraged a guarantee by the Kreisky Foundation, a $5 million guarantee to support co-lending among these two CDFIs for health centers. And this guarantee was further leveraged to bring up to 132 million in financing the total capital available. By the end of this origination period in mid-2016, the two CDFIs had validated their lending practices, and they were then able to leverage private investor capital without needing such a guarantee any longer. This is a concessionary investment by the Kreisky Foundation because the Kreisky Foundation will not receive a return. It differs from commercial expectations because guarantors are not remunerated for the risk and they can absorb potential losses. It is needed because the CDFIs had no experience in lending in the newly developed federally qualified health center market, and the input that it catalyzes was to validate the lending practices of the two CDFIs and eventually making them able to raise capital from the private sector. The following two case studies are about purpose, accepting non-traditional terms to meet the needs of an investee, such as unconventional or no collateral loans, self-liquidating structures, smaller investment sizes, higher transaction costs. The first example is about Navajo Power. This is a public benefit corporation that develops utility-scale clean energy projects on tribal land in the United States. They promote a just transition from coal to renewables for the Navajo people through solar and storage projects because there is an imminent closure of local power plants and there will be a loss of jobs. In 2020, Navajo Power offered a loan with a 5-year term, and investors could choose an interest rate ranging between 1% to 3%, with no penalty for payback before the end of the term. But among the unconventional terms of the deal, there was also a turquoise share, which was established to allocate 10% ownership for community benefits. For the sake of this example, we will focus on this turquoise share. It is concessionary because the turquoise share dilutes the other equity investors. It differs from commercial expectations because Navajo Power is sharing with the community equity and voting rights. It is needed because it aligns the company interest with the community that it serves, And the impact that it catalyzes is to address disenfranchisement for indigenous people in the United States, and also to create a replicable model for other communities in the United States. Another case study about purpose, it's Aquaspark. This is a global fund that develops an optimal and sustainable aquaculture food system. It invests all along the value chain to solve industry challenges with a shared vision of sustainably feeding the planet with high quality proteins. When Aquaspark started in 2014, the aquaculture industry had an extremely negative reputation because of the poor environmental practices of many farms. To change that, Aquaspark had to propose and finance a new aquaculture paradigm by developing an entire value chain and transforming the entire industry, from better production practices, insect feed that replaces fish meal, solution to antibiotics overdosage, feeding technologies, and so on. To implement this bold vision and create synergies in the portfolio, the fund really needed a long-term approach. So instead of using a traditional 10-year fund, they launched an evergreen fund structure holding company that could maintain long-term ownership and steward companies in the long run. It is concessionary because the investment, like limited partners, investors, don't have a limit. The fund doesn't have a limited life, so the investors have to rely on a sale of their shares or a buyback from the fund for their investments. So there is no immediate visibility on the liquidity. It differs from commercial expectations because evergreen equity structures are very rare in impact investing. The vast majority of funds have a limited lifetime, and if you see evergreen structures, they are most likely loan funds. Uh, Evergreen companies are mostly seen in financial markets for non-impact investments. I'm sure many of you will be familiar with the holding companies such as Berkshire Hathaway, where investors can exit by selling shares on the stock market, where it's not the case for Aquaspark, at least yet, because it's not listed on the stock market. So there is no immediate liquidity opportunities for investors. It is needed because this novel evergreen structure provides a long-term approach to change the industry and create portfolio synergies. And the impact that it catalyzes is to seed and validate new technologies and best practices to feed the planet sustainably. The forms that we have just discussed are actually features specific to every single deal. In other words, price, patience, position, pledge, and purpose may or may not occur together. A deal with a price form can also have patience or terms, novel terms, to contribute to specific impact. Also, in some instances, you may find yourself in the giving end, and in other instances, in the receiving end. For instance, you might make an investment in a blended fund structure where somebody else is taking a first loss position before you, but at the same time, you may be both accepting a longer-term patient investment with sub-commercial returns.